Hello. So I've created an example here for us to understand what variables to look for in each one of those examples and populate that template. So price per earnings ratio, what does that mean? So that means that the lower the better. It means that the price per share in relation to earnings per share is cheap or expensive. So let's have a look at this. So for Mondelez International, as you can see, I'm on Yahoo site. Is 23. So we'll get it here, populate 23. Whereas for Kraft Heinz, will be 138 at this point in time. The reason why is because Kraft Heinz had an anomaly. They had to write off one of their brands. Basically, what that means is that they paid too much for that brand, and therefore their earnings in this period suffer because of it. Then the second thing is price per book. So again, the lower the better, means that if the company had to sell all of its assets in order to pay, let's say in the event of bankruptcy, that the company would survive. So the ratio of share per book value per share should be low. So a 1-to-1 PB ratio means that the company assets are worth the same value as the price of its shares, virtually a risk-free investment. So if you cannot find directly from Yahoo Finance, what you can actually do is go through a site like Guru Focus and try to find out Yahoo has does provide us with that. So it's free for Mondelez, and then about 0.98 for Kraft Heinz. So what this is telling us is that because they wrote off their brand, if you go, you can see it. What that means is Kraft Heinz earnings hit by write-downs. So the write-downs on Oscar Mayer and Maxwell House and several of its well-known brands. So that basically means that because they wrote them off, um, their value, their assets doesn't worth as much, but their earnings this period took a hit. So that basically means that in the short term they will be worse off, but in the long term, it's you seems like a healthy company. The third variable we're gonna have a look at in terms of valuation, which is the current price in the company, is the company being able to extract value from their assets? Are their assets quite valuable? So the return on assets is basically have a few assets. How much can I make a profit out of utilizing those assets? So I'm going to use this site here, Guru Focus. They give 6.9 for Mondelez and 4.17 for Kraft Heinz. 4.17 for Kraft Heinz. So as you can see, in terms of PE, at this point in time, Mondelez is in a better position. In terms of book value, Kraft Heinz are in a better position. In terms of return on assets, Mondelez are able to extract more. To move on, is executive compensation is three different variables. Is the performance of the executive board more related to stock performance, then that is a good thing. You want them thinking like an owner in favor of you, shareholder, because you're an owner too. So, and then another thing that we'll look at is Glassdoor review, how and what the employees think of the company. And then last but not least, do they have any credentials or are at their genius level? So led by genius by like Jobs, Musk, Gates, or has the board have credentials with turning around similar companies? So, for instance, in Mondelez, if you look at LinkedIn, you're going to see that Dirk van de Put, and he's a former CEO of McCain's Foods Limit. He achieved amazing results there, and the rest of the board has been in Mondelez for a long time. Kraft Heinz, very young managerial. So they had, for instance, their former CFO had 29 years old, quite young, born. They have very ruthless cost-cutting style, no long-term credentials, but that also means that their stock, their compensation are a lot healthier than Mondelez. This is the site that I use, so you can view the compensation of the board. So you can see that Dirk, for instance, 2019, he earned about 18 million. The CGO 4 million, the rest of the board 4 million in general. Then what you want to see as well is how much of that is cash, how much is equity, how much is other, really. So for instance, in terms of Dirk, 6 million in cash, 11 million in equity, and then the rest is in order. That's more or less the rest of the board as well. So it's a bit like 35%, 30% cash, and then the rest equity. CEO, so that's going to be a little bit different, but their CEO earned 43 million. How about the rest of the board also had some strong compensation, 11 million, 15 million, 7 million. So the total compensation is higher than Mondelez, that's for sure. In terms of, let's look at their details. So basically, most of their compensation is in equity rather than cash. Actually, 95% is on equity, 5% in cash. That's a good compensation, but the CEO pay ratio against their employees is quite high. So they take a good thing in terms of composition, but the amount is very large in comparison to Mondelez, Glassdoor, Kraft Heinz. So this is the wisdom of the crowns, really. You gotta trust the numbers because you got 500 ratings. It's quite a good sample. So it's a 4 stars for Mondelez. Y is for Kraft Heinz. You got about 130 rating. You can trust that. It's 3.4. So you can see that they are doing a better job in terms of keeping their employees happy, which is also an important part. So for the next part, you want to see the growth prospects of the company. How do you do that? Well, you look at revenues, you look at earnings, you look at the debt in the balance sheet, you look at the industry prospects. Is the company a growth company or is it a value company? What's their macro sector analysis? Are they defensive, cyclical, or consumer industries? What's the best performance of that investment, and what's how much they're investing on innovation? So let's have a look at that. So in revenues, you want to see consistent growth. So you can see that Mondelez from 2017, 25.9, again 25.9 million in 2018, 25.9 in 2019, 26.5 in 2020. So what this is telling us is that the revenues of this company is extremely consistent. They just had a spike in 2020, probably because of lockdown and people buying more take-home packs. But overall, the revenue is the same across. But what we need to have a look as well is, well, you get it. So the second most important thing is for us to understand how much earnings they're taking home, right? So, and you're going to see the entire list of things on the balance sheet. But if you want just a summary, you would look at a graph like this. So you can see that the revenue is pretty much static, but conversely, the earnings are consistently improving. So 2.83 billion, 3.32 billion, 3.93 billion, and then 3.56 billion. Problem in the last year is because they grew their revenue, but then on the opposite side, they had to spend more to grow that revenue, probably because they had to pay staff over hours in the factories. A lot of people were off sick, so they had to hire staff at additional pay, things like that during the lockdown. But overall, it's looking pretty good for Mondelez in this part. So let's look at Kraft Heinz. Kraft Heinz, the revenue is actually decreasing, They did stabilize last year, but the revenue is a bit crazy. And then, as you can see, in the earnings is all over the place. And the reason why it's all over the place is because their accounting is being very poor. They hired CFO, who was 29 years old. You can Google it, it's David Knopf. And he pretty much got into a mess in terms of brand accounting practices. But it's not all his fault, of course not. Basically, Warren Buffett and 3G Capital paid too much for the craft business. Their brands weren't worth what they paid for. And as Cathy would say, it was a value trap, meaning that they had to write off the value of those brands later on. And that's the 10 billion impact that they had. And again, in 2020, they had to write off brands again, which impact their revenues, their earnings significantly. But it surely doesn't look good because since 2017, the earnings have been just decreasing. Okay, so we've plugged in the revenues, very similar businesses, very similar revenues, 26 billion. The earnings, very different. Basically, Mondelez are able to extract 10 times earnings versus Kraft Heinz. And we already knew kind of that because the return on the assets were a lot higher for Mondelez. Um, so we already knew the movement. They are both value industries. So that basically means that the company isn't really looking like to grow the revenue that much. It's more about cut costing. So the cost cutting is the main driver on how the industry is going to look like in 10 years' time. That basically means that the PE ratio should be lower than the likes of Amazon, Tesla, things like that, which are growth industries. The earnings, the higher ratio of earnings to revenue, the better. So you want to analyze the cost of revenue. You can also see that by looking in the income statement. They're both in the defensive sector. What does that mean? A company can be in the cyclical, defensive, or consumer industry. That basically means that whenever there is a crisis coming up, the defensive industry is the one that is more likely to fare better than the other industries. Okay, the next one in line is debt. So debt can be found in the balance sheet. So I can already point out to you. So Mondelez has a total debt of 20 billion, which is a hell of a lot. But they also have some invested capital. So their net debt is actually 16 billion. Those numbers are in the thousands, by the way, as you can see here. So it's a billion that I'm saying. So it's quite high debt if you think about it. They almost have about 60-70% of the revenue in debt. Kraft Heinz is even worse. 25 billion in net debt. So Kraft Heinz has was a deal straight from private equity. Private equity loses leverage quite a lot. Leverage equals debt. So that makes sense on why they have that. But that is dragging into their earnings because every year they need to pay the interest on that debt. Nowadays, interest is very, very low, so that is not eating that much. But once the interest rates are higher internationally, they will suffer a lot more. Now, let's look at the past performance over the last 5 years. I've got it here. So Mondelez, 5 years, 38% up. Was Kraft Heinz, since the acquisitions, 49% down. So that's doesn't look good at all for Kraft Heinz, to be fair. But this is the least important of the things that we look at. Why? Because of a phenomenon called regression to the mean. What does that mean? That means that a result that was achieved in the past doesn't necessarily mean that it will be the same result in the future. In fact, a lot of cases you have the exact opposite happen because a company fared very poorly in the past. They turn it around and it's a lot easier to grow on a lower base than in a higher base. So Therefore, it will be a lot easier for Kraft Heinz to grow than Mondelez to grow. So that's why it's a phenomenon in a book called Thinking Fast and Slow by Daniel Kahneman. Sometimes people who perform poorly in the past, they have a chance of performing greatly in the future just by the lack of chance. Because on the long term, average people should do average companies should do average. The next thing is innovation investments. This is the kind of thing you're only gonna find out into by reading the company's report or by looking at the news. So just so you know where to find out, you go to Mondelez report 2020. There you go. There is a full year, Q4 and full year 2020. You look at what kind of investments they're doing by downloading their entire report, and then you read it there. Another way of doing that is basically looking at the invested capital the company have, looking at the assets, how much is its current assets versus non-current assets. Okay, so this is an example of what you want to be looking at. You want to be looking at a brand that is reinvesting in its production to become more efficient, increase productivity in its operations. So last year, Mondelez had a very good earnings year. So therefore, what did they do? Well, they chose to invest 15 million to ramp up production at Bourneville. So as you can see, if you read the news, basically it will just enable them to produce an additional 125 million more of the large sharing bags. So that's pretty impressive. So that's the kind of thing that you want to see. And if you read through the company's reports, but this news is making it easier for us, is that the company has already invested more than 80 million pounds at the site since 2014. And then the production efficiency has increased by more than 30% during this period, which is very positive to see. So output Mondelez is high in terms of investing for growth. And while Kraft Heinz, if you look at it, it's pretty average, really, if not low. So that's pretty much what it is. So the next in line is dividend. So dividends is a very straightforward. So it's the higher the better, and you want to be asking if it has increased consistently across the years or not. So dividend is a piece of the profit that the company is sharing back to the shareholders, and basically it's kind of the return that you see every year for new investments. Pretty nice to see and pretty nice to touch, something tangible that you have from your investment without selling your position. So as you can see, Kraft Heinz is giving £1.60, let's say $1.60 for every share per year, and that corresponds to 4% of their current price of 40. So let's put it here. So 4% yield. Then what you want to see as well is whether they have been increasing their dividends or not. Whilst we look at that, let's look at Mondelez as well. Mondelez has been giving 1.26 across the year, and that for a $59 share, that's 2.16. So Heinz have been more generous about their dividend yield. That doesn't necessarily is just a great thing, because that also means that they're not thinking about new ways to reinvest that money into the business. So whereas Mondelez UK only has reinvested 80 million in their plan, and Mondelez UK is 10% of Mondelez Global. Kraft Heinz is a lot lower than that. Why? Well, maybe because they're giving it back to the shareholders. It's not a good or bad thing. It's just that one makes a company that is more interested into their future growth, and the other one makes a company that is more interested in the short-term results and giving back to the shareholders. And then you can shape your portfolio to make sense and adjust your portfolio accordingly to make sense to you and me. Here's the dividend history of Kraft Heinz. As you can see, they've actually increased a little bit the dividends and then drastically cut. So this doesn't look good for them. That basically means that that they cannot pay the dividends that they have been promising the long term. It wasn't sustainable. Who is now to say that it is at the moment, right? So not a thing that you would like to see. So in dividend history, I would say inconsistent and declining. So not very good. For Mondelez, the exact opposite. They've been increasing dividends steadily, so that's a pretty good sign. Consistent and growing. Dividend potential, they're both in the value industry, they're both defensive. I don't believe that they have huge dividend potentials unless they give up on their growth. So I would say NA. Okay. And now balance sheet and cash flow. So you want to see again that the current assets minus the current liabilities. So how tangible is the current flow? It's very easy to inflate non-current assets, and because you're talking about things like brand, what's the tangible value of a brand? It's very hard to say, isn't it? So therefore, you want to be very careful with non-current assets. Whereas the current assets gives you cash at hand. The second thing we're going to look at is the shareholders' equity by the total assets. So just reminding you, the formula is total assets equals total liabilities plus shareholders' equity. Shareholders' equity is how much you own of that company, the percentage that company that is up to the shareholders. And then the last question is, are they getting more debt or not? Can they survive a crisis? Things like that. So let's dive into the balance sheet. Okay, so we are first looking at the income statement. So you can see the total revenue here. If you open that total revenue, you can see the operating revenue of the company. Sometimes they have more types of revenues, but that's the only one for Mondelez. And the cost of revenue, how much they had to spend in order to achieve that revenue. So you can see it's quite high as well. And that gives the difference between those two, gives us the gross profit, right? So then the gross profit, you're going to take operating expenses. Operating expenses are things like selling, general, and administrative. All that means is salary to the employees, and then depreciation and amortization of the debt. So that's how much they've paid off their debt. So they are paying very little of the debt every year, but they are paying something. Then the next in line is net non-operative interest income expense. So interest expense non-operative. So that's their Mondelez paying their annual debt interest. So they're pretty much spending on their debt the sum of those two. So this one, 423,000 plus 194,000. They're spending about 600. Actually, it's not thousands because these numbers are in the thousands already. So they're spending about 600 million in their debt every year out of their 26.5 billion revenue. Okay, so moving on, you get to the net income to common shareholders, which is about 3 billion. So that is what is going back to the shareholders as a form of dividends. Move on to Kraft Heinz. So Kraft Heinz total revenue is the same way, only has operating revenue 26 billion. Cost of revenue pretty high too, 17 billion, which gives us a gross profit of 9 billion as the difference between those two. Then we're going to take the gross profit and deduct the operating expenses, salaries of employees, 3.6 billion. You can see that even though they have very similar revenues, Mondelez has an operating expense almost double as Kraft Heinz. That basically means that Mondelez can still probably cut their workforce by half and still achieve similar results to Kraft Heinz. So you can argue on that way. But the thing about reading those things is that it's never black and white. It's all to interpretation. So you need to interpret the data in the way that you see. The more information you have, the easier it is to do that. So that is the interest expense that they have. Pretty high interest payment. But if you look at the past, what did we put into that? We have 25 billion. That was Mondelez has 16. So that's what's driving that very high interest payment. It does other income expenses is basically because they wrote off their brand equity, so it comes here in the other income expense as special income charges. That is only a one-off, so there's nothing to do with interest. It's about accounting for their brands. So their interest is 1.3 billion payment. Okay, then they have the pre-tax income and the tax provision. So the tax provision is calculated based on the pre-tax income as a percentage of it. And then finally, you have what's left for the net income come shareholder, so, which is 356 million compared to Mondelez was about 3.5 billion. Okay, the next in line for us to look at is the balance sheet. So you can see that the total assets have total current assets and total non-current assets. Current assets has cash, cash equivalents, receivables, inventory, and other current assets, whereas the total non-current assets is about goodwill, which is the value of their brands, investment and advances that they hope or have in contract that they will receive in the future. Whereas the total liabilities, quite similarly, current liabilities that what is payable right now, current debt, and pension that they need to pay for their employees, and then total non-current liabilities, long-term debt, employee benefits for the future, things like that. So you can see that the current liability is a lot higher than current assets. Not so good to see, but overall, the total assets are a lot higher than total liabilities. So the company won't go bust unless there is something very black swan about it. Okay, so the next thing that you want to look at here is basically how much is in common stock equity. That's the difference between the total assets and total liability. So you can see that it's 27.5 billion. And basically that is the next most important thing here. Then we're going to look at Kraft Heinz balance sheet as well. So their total assets are pretty big, but it's mostly on total non-current assets. That basically means that they value their brands quite a lot. That basically, if you look at it, and the total non-current assets have been declining. Why? Because they've been writing off the value of those brands. So that nothing beats them to do that again in the future as well. So I wouldn't rely too much on their total non-current assets. But their current assets are higher than their current liabilities, so there is nothing that much to worry about. Okay, last but not least, we're going to look at cash flow. So cash flow of Kraft Heinz, basically, what you want to see here is whether they're issuing or repaying debt. So issuing of new debt 7.5 billion, repayment of that 8.67 billion. So net, they've actually been repaying their debt. They have been decreasing their debt, not increasing, but they're still rolling that debt quite a lot because they're creating new debt to roll the old debt. So healthy, but could be better. Mondelez, they are issuing new debt and repaying the old debt just the amount necessary that they have to. So all in all, they are actually getting more into that, which I understand why, because interest rates everywhere are close to zero, so they get more into that so they can, reinvest in their business. That's pretty much standard practice, but not something that I personally love to see. Okay, so to finish this off, what I've done here is to put in green when one of those companies had an advantage over the other, put in red when the opposite was true. So green's good, red is bad. And then I count 1 point for each green there is. And then, so through the pillars of valuation, executive compensation, and management, growth prospects, dividends, balance sheet, and cash flow, Mondelez turned out to be 10, whereas Kraft Heinz turned out to be 5. So there's just one way of looking at it, but it's not set in stone. It's not black and white. It's more about the whole story rather than counting points. That's just to help me out. But people do this differently, so take this with a pinch of salt. So P ratio, as a recap, P ratio a lot healthier for Mondelez, 23. Price per books ratio a lot healthier for Kraft Heinz, almost 1-1, meaning that if they were bankrupt tomorrow, they could pretty much sell off all of its assets and pay their shareholders what they owe them. Return on assets, Mondelez is more efficient than Kraft Heinz over their assets, maybe because the Kraft Heinz assets are a bit inflated. That's a question mark. Executive comp in Mondelez average, Kraft Heinz very high. Composition of Kraft Heinz makes a lot more sense to incentivize the executive board to be in, to turn around the company. Glassdoor reviews 4 stars from Mondelez versus 3.4 for Kraft Heinz. So employees like the company better. If they like the company better, they work better. Credentials, they have more credentials. No genius in either side, but Mondelez executive board have more credentials. Earnings, healthier earnings for Mondelez, lower debt for Mondelez, better performance in the past for Mondelez, innovate, clear historic innovation investments story for Mondelez of 80 million, dividend yield better for Kraft Heinz, dividend history consistently growing, therefore better for Mondelez. Current assets minus current liabilities healthier for Kraft Heinz. Mondelez are getting more debt, but they can still survive a crisis. But Kraft Heinz are in a better position because they are paying off their debt. So all in all, the answer is that if I had to compare, you always want to compare apples to apples. So you want to compare industries that are kind of similar. They're both value stocks. None of them are growth, because when you're talking about growth stocks, you wouldn't look at things like P ratio because they don't make any sense. You would look at potential for growth a lot more. They're both in defensive industries, so they're clearly apple to apple. You're not comparing apples to bananas, and therefore the comparison would get all messed up. So if in your portfolio you need a stock like this in order to diversify, you want to compare them both, and comparing them both, Mondelez is clear the winner here. I hope you like this. If you did, let me know so we can do it more, and drop in the comments any suggestions of stocks that you want me to compare, and we can do that more times. Thanks a lot, and see you next time.